Have you heard of systematic risk? Well, let me give you some examples. Inflation, 9/11, war, recessions, and even higher taxes. These risks are uncontrollable. There is no amount of diversification between asset classes that can protect you from systematic risk. But before I stress you out about the possibility of another world event that will trigger systematic risk and send your retirement portfolio into a tailspin, let's talk about retirement insurance in the form of a principal protection program that only a life insurance can provide, and see why only a life insurance company can provide you this retirement insurance. By the end of this video, I'll give you the facts so that you can have a better understanding of why an insurance company, and only an insurance company, can provide you principal protection. Hi, my name is Darlene Hartman. I'm a CPA and founder of D. Hartman Consulting, LLC. For the best retirement annuity advice, subscribe to my YouTube channel and hit that notification bell so that you can receive notices anytime I post a new video. Systematic risk is the risk that's inherent in the entire market or economic system. Examples would include inflation, war, recession, 9/11, and even higher taxes. These risks are uncontrollable, and they can wreak havoc on your retirement portfolio, no matter how diversified you are between asset classes. So for example, in the Great Recession of 2008, equity indexes were down 30%, junk bonds down 40%, real estate was down 8%. So asset allocations and traditional diversification cannot prevent catastrophic losses from systematic risk. So how do you manage systematic risk? Well, by transfer of risk from the markets to a large insurance company. So in other words, you're going to sell a portion of your risk in the markets to a large insurance company. In return, you're going to receive 100% principal protection, including protection on any contractual guarantees, which may include those invaluable mortality credits that exceed the amount of principal invested. So you may say, what's the trade-off? Now, with respect to a fixed indexed annuity, you're only credited a portion of the gains from the market index because those gains are capped in order to ensure you downside risk protection. So don't forget about that 0% floor on a fixed indexed annuity. Statistically speaking, your chances of loss of principal from investments over a 12-month period is over 21%. So if you think about it, we have auto insurance, we have homeowners insurance, we have health insurance, we have life insurance. So why aren't more people obtaining retirement insurance to protect from the loss of principal on investments? Leave me a comment in the section below and let me know how much less anxiety you feel knowing that you can transfer risk from the market to an insurance company and still receive a portion of gains from market indexes in a fixed indexed annuity. Also, if you're enjoying this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and hit that notification bell so that you can receive notices anytime I post a new video. Now, how much trust can you put on an insurance company to deliver on promises that were made maybe as much as 20 years ago? Well, historically, insurance companies have been solid in delivering on their promises for 100% principal protection, including contractual guarantees in excess of the amount of principal invested. To date, no one has lost a dollar from an insurance company. So how is it that insurance companies have been so solid in delivering on their promises for contractual guarantees and are able to manage systematic risks such as war and depression? Well, insurance companies are highly regulated. They have very tight restrictions on leverage. In other words, they're limited in the amount of money that they can borrow. They also have highly liquid investments. Insurance companies need to ensure that they have money accessible to provide for those contractual guarantees to the annuitant, along with the death benefit for the annuity beneficiary. Of note, insurance companies are actually the biggest buyer of bonds in the United States. There's also this communal attitude between insurance competitors unlike any other industry. So no insurance company has ever filed for bankruptcy, but they have exited lines of businesses. So what happens is that another insurance company will pick up that book of business, ensuring those contractual guarantees. So if you think about it, if an insurance company ever filed for bankruptcy, no one would ever put money into an annuity policy. If you're interested in obtaining retirement insurance for the financial security, certainty, and happiness that it can provide you in your retirement, and the protection it can provide you from systematic risk, click the link below to apply to become my client. Also, be sure to give me a thumbs up, subscribe to my YouTube channel, share it with your family and friends. Thank you for watching. Let's get the conversation started on how you can live your best retirement while not outliving your money.